Good morning and welcome back to day 3 of 3 workshops with FinTech Alliance. Today we're going to be covering term sheets. And as a reminder, Tuesday we talked about putting your best foot forward from an engagement perspective with investors. Yesterday we covered types of funding, tips on engaging with investors, and also how VCs work. And today we're going to be talking about term sheets. A bit more detail, we've got 45 minutes or so. I'll be covering the key terms and a few tips on negotiation and trying to discuss and try to identify terms, typical terms and term sheets in plain English. Then we're going to be joined by Anthony Rose, who's the CEO of Seed Legal, to talk about his experience. Arguably, he probably sees the most amount of data across the UK seed scene in the UK. And then we're going to be joined by Alex and Olivia, Alex from Mount's Ventures and Olivia from FinTech Alliance for a panel. So we've got another packed hour and a half or so ahead, so stay tuned. So for those who have joined recently, who might not have been over the last couple of days, quick background as to Mount's Ventures. So we help the most ambitious entrepreneurs raise the next round of funding. We do that in 3 different ways. We help entrepreneurs get investor ready. We then introduce them to relevant investors, and then we help them close the deal. And our aim is to make that fundraising bit as efficient as possible for both the entrepreneurs, to help them raise in a time such that the entrepreneur, the CEO can spend more time actually growing the business, and also supporting investors, so that instead of sourcing, saying 1 in 1,000, 1 in a couple of hundred companies, actually the companies have gone through the program are much more likely to then raise and receive investment. Again, for those of you who tuned in yesterday, you remember this diagram. We talked a lot about the way investors work. And if you missed that, I'm sure the FinTech Alliance team will then will be sending you an email with our recording. If not, the way that we work at Mount's Ventures is, as well as supporting entrepreneurs through the next round, we also work with VC funds. We work with VC funds by supporting them raise their own round of funding, and therefore we're in a really good, unique position to be able to identify which investors are raising, which investors are deploying, and also have a good breadth of the family office network. Typically, family offices are the largest investor in those emerging fund managers, i.e. the people that you're pitching to when you're asking for VC money. And the 2 initiatives, as a reminder, we've got the funding venture initiatives, which are conferences and dinners that we organise to connect those limited partners, the corporates, the endowment funds, the family offices, and those VC funds. And the Capital Behind Venture, which is the largest survey of its kind, looking specifically at investors into VC funds, which we're running with the British Venture Capital Association and a whole bunch of other partners. You can Google that either and find a bit more information on the website. Again, for those of you, my name's Jonathan Hollis. I'm the managing partner at Mount's Ventures. My background is I founded an ed tech company before PwC, then spent a number of years getting my qualification in accounting, then worked on valuations and IPO before co-founding 2 new propositions at PwC. And you will hear from Alex later on today, and John introduced himself on Tuesday. Quick background, we've worked with over 400 companies across a whole bunch of different countries. We've seen lots of term sheets, and actually this is the topic of today. We're a firm of chartered accountants, and we're also a member of the BVCA, which is the body in the UK that looks after the VC and PE industry. Of course, we are specialists in fundraising, but we bring a number of different people across the network to support us across the other key areas, such as sales and marketing, such as selling, such as social selling, such as social media, and also actually building a team, as well as the legals. And actually, we'll be hearing from Anthony on the legals in about an hour or so as well. We've got a good breadth of relationships across the spectrum. So we know the majority of EIS and VCT funds in the UK. We've got a whole bunch of CVC and family office relationships, but our focus really is on those venture capital funds. And the reason we're able to map so many, and the reason we're able to actually engage so many, is, as I've said before, we actually support them in raising their own funds, with the objective really of better supporting entrepreneurs. Because by understanding who's raising, actually we can put you guys in front of the key investors in your different sectors. And a couple of nice things that investors have said about us over the last couple of years. So let's get straight to it. So understanding term sheets and the key terms. So the objective of the next 40 minutes or so, I'm going to be running you through the way that we at Mount Ventures look at term sheets. So split into 5 different categories. And I'm going to do my best to explain what all of those terms mean in plain English. Feel free to ask questions. There's a questions option open on your right-hand side of the screen as I go along, if there's things you don't understand. But I'll do my best to try and make it as simple as possible. And then hopefully we'll also be providing a little bit of negotiation points as we go along. So as well as understanding what the basic terms mean in plain English, a couple of things that you as founders may be able to leverage and tease out of those investors when you're discussing the key terms. So the way we look at term sheets, there's 5 different areas: price, control, deal conditions, binding terms, and other. These are universally, I think, across all the different terms that you might come across, amongst different types of investors. They come in different names. Price sometimes looks at the economic terms. The deal conditions and control are sometimes bundled together. But typically the binding terms are consistent across the different terms, as are some of the other items. But we've tried to put them in sensible categories for you to actually be in a position to understand them. So let's start with the most important one: price. So price, the key term on price is, of course, the amount that's going to be invested. So the amount that's going to be invested from the investor into the investee company. And then, of course, the corresponding valuation. Those are, of course, the two terms that are the most significant for both the investor and the startup. And the way investors typically do this is by creating a new class of shares. So they create a new class of shares at a specific price per share, and that price per share is what dictates the valuation. Once that unique class of shares has been created, the distribution, the preference behind that class of shares will then dictate what happens upon a liquidation event, i.e. when a company is sold, when a company is bought, when a company is listed. All these different liquidation events, i.e. all these different exits, all of those will then signify and lead to a certain distribution for the founder and for the investor. So the 2 typical classes of shares that you may come across are your ordinary shares, which simply pay in the proportion of the amount of equity they hold, and the preference shares. Preferences, there's a whole bunch of different terms that could be associated to this, but just think about them as a benefit that shareholder gets, as well as having the share. So it's kind of like an ordinary share with a bit of with an add-on of some kind, and there's a whole number of different add-ons that may be implicated in that. So I'll come on to some of the preference terms in a minute, but just before thinking about the amount of investment that comes in, a lot of investors, in order to further reduce their risk, may invest through milestone investing. And milestone investing essentially just means that in order to further protect the downside, an investor may, instead of investing £2 million at once, they may invest 1 million and then come up with a whole bunch of milestones that are required to be hit in order for you to qualify for the further tranche. That is a nice way for them to lower their risk, because it means instead of having a £2 million check out, they're protected because it's a 1 million plus maybe a revenue growth metric, or maybe a user growth metric, or maybe a cost metric. And these can be limiting for entrepreneurs from both a psychological perspective, because you haven't got all the money in the bank, but actually it's a nice way for investors to further protect themselves. The key advice I would give to entrepreneurs in this regard is to only agree to milestone investing if and only if you as a management team are confident that you'll be able to hit those metrics. If you're not confident that you can hit those metrics, it's not a good deal to go into, because you'll be worrying, you may not hit them, and actually you may not then go on to proceed with follow-on investment. So let's turn to preferences. So the objective of preferences, I think if you're putting yourself in the investor's shoes, which was the topic of conversation yesterday, that it makes sense, right? Because if I'm an investor and I invest in a company, my biggest worry is that I invest at a certain valuation, and then you as a founder exit at a valuation that's lower for the amount that I'm investing. So if I'm investing a valuation of £5 million and I'm putting in £1 million, and you exit at, let's say, 2 or 3 million, if I invest 1 million and the value with a pre-money of 5, and I own 20% of your business, and you exit at 3 million, I, as an investor, I'm worse off. I'm worse off because I put in 1 million, and if you're exiting at 3 million, I'm getting a lot less money back than I put in. And in order to protect the lower valuation, what an investor would do is create a liquidation preference of 1 times, which effectively means that if you exit at a valuation lower than the one that I put in, or if you exit valuation higher whereby I don't get all my money back first, then there's a kicker whereas I get the return first. So in the example I mentioned that the investor puts in £1 million at 5 mil valuation and takes 20% of the business, let's assume, and you then exit as a startup at a 3 mil valuation, i.e. a valuation lower because, I don't know, you want to leave, or there's various different reasons, the investor gets their £1 million back first. And I think that's a very reasonable ask for an investor. What it means for 1 times liquidation preference on an exit, if it's a bigger valuation, it also makes sense, because what happens there is if you exit a 10 mil valuation and the investor has a 20% stake in the business, they not only get their 1 million first, they simply get the allocated equity pro rata amount from the 10. So in this example, they get £2 million, which makes sense. So if you're exiting at a value that's higher than what they put in, they simply get the amount that they own the business for. If they exit a value lower, they get their money back first. So that is market, and that is called a 1 times non-participating preference. And I think there's a consensus now that the entrepreneurs and investors understand that logic. Where it gets particularly sensitive is when it's more than a 1 times liquidation preference. So you've got instances where if an investor has a 2 times liquidation preference, what that means is they get 2 times their money back, or they get to then take the equity pro rata amount. So in the example that I mentioned, where there's a £1 million investment at a £5 million valuation, and you exit at, let's say, a £6 million valuation, if the liquidation preference is 2x, what that means is the investor gets 2 times the investment they put in first. I.e., if they put in £1 million at a 5 mil and you exit at 6 mil, before you as a founding team get any return back, the investor gets 2 times 1 million, i.e. 2 million. So in this circumstance, the investor gets 2 of the 6 million. So you can see that that's higher than the 20% equity they hold. Now, of course, if the entrepreneur exits at a 50 mil or 100 mil valuation, the 2 times liquidation preference kind of falls away, because the investor doesn't want to get 2 times their 1 million. They're much more likely and much more incentivized to simply convert their preference into an ordinary share, and therefore simply benefit from 20% of 100. So in this case, if they're exiting at 100 million, they get 20 million rather than the 2 times 1 million. And that makes sense as well. So the sensitivity with entrepreneurs and investors is when an investor invests at a liquidation preference that's higher than 1 times, what they're doing is they're not only protecting their downside, i.e. if you're getting a lower valuation, they get 1 or 2 times their money back first, they're also increasing their potential upside by getting additional return from a higher valuation. And I'm sure that will be an area of topic for the conversation later on in the panel. Now, the second element to consider, it gets even more punchy for entrepreneurs when you look at the actual liquidation participation. And liquidation participation, there's 2 different roads. It's either participating or non-participating. Now, these terms, if you're coming in cold, are quite unusual. The market is a non-participating preference, and what that means is if I'm an investor and I put in a £1 million into a business and I have a liquidation preference of 1 times, I get my money back first if there's a lower valuation, and I probably get simply my 20% if it's a high valuation. Now, if it's participating, it gets a bit more tricky, because what that implies is something called a double dipping. And a double dipping is when the investor, at every point of the valuation, always gets 1 or 2 times whatever you negotiate on the liquidation preference. But then once they've got their money back first, i.e. in the example where they've invested £1 million at a 5 mil val, if they have a participating 1 times preference, what happens on a 10 mil valuation is that not only do they get their £1 million first, i.e. at a 10 mil val, you give 1 million to the investor, which leaves you with 9 million. What happens then is they then get to benefit in proportion where their equity holding of the remaining 9 million. So they get their £1 million, then they get 20% of the £9 million, which, if you're having an exit which is not significantly greater to the amount that they invested in, can be quite material for them. If your exit, and if you're an entrepreneur who's aiming at a 50 million or 100 million valuation, you can see that this is a very, very trivial number, because at a £100 million valuation, a participating 1-time preference means that your 100 million, your return profile looks like, first of all, your investor gets the 1 million, so then you're left with 99 million, and then that 99 million gets divided equally, gets divided as per the pro rata, i.e. 20% for the investor, 80% for the entrepreneur. So at a high valuation, you can see that the double dip doesn't have that much of an impact, but at a lower valuation, it certainly does. Because you can imagine the case where if you have a down round exit, i.e. you're exiting at 3 mil rather than 5 mil, and a participating 1-time preference, you can see that actually the investor gets the 1 mil first, and then they get to benefit 2% from the 2 million. Cool. So there was a comment from Robert mentioning, surely for much relate around liquidation participation. So what we've seen frequently with liquidation participation is it differs for the type of investor that is investing. So for the top tier or for the mid tier, you'll recall from yesterday's discussion that those investors are looking for the unicorn. So it makes perfect sense for the unicorn investors not to care about liquidation preference, not to care about liquidation participation, because they want your business to be a £50 million business. So why are they going to bother negotiating for a £1 or £2 million or 1 or 2 times liquidation preference? It doesn't make any sense, and the market shows it doesn't, and they don't. And as a founder, that's something for you to bear in mind. However, you'll recall yesterday there's a tax efficient group of investors, the VCTs and the EIS funds. They care about downside protection because they are happy with 3 to 5 times return. And in order to further increase their potential returns, and in order to further ensure that they protect their downside, because remember, a lot of these investors don't want all their businesses to fail. If a business gets valued at a lower valuation, they don't want to lose all their money. And so they are more likely to have liquidation participating, maybe 1 times non-participating, or 1.25 or 1.5. So Robert, to answer your question around later rounds, it's much more likely a smaller round for a tax efficient investor who's looking for a 5 times return, who's protecting their downside, than a top tier. The slight nuance with later rounds is often you can think about it as a preference, as effectively what the founder gets in an exit, and therefore for later rounds, before you as an entrepreneur get your investment, there's a whole bunch of investors that need to get paid first. And this is what sometimes is very problematic. So you might remember when Uber, when Uber were listed and when Uber raised their bigger round, a whole bunch of their employees got nothing. And that's because all of the employee share options were stacked to the bottom of the return distribution. All the investors came first, and then the management team came first, and the employees were left at the very bottom. And so that structure is very important. So that's price, and that is a significant part of all term sheets. Let's talk about control now. So control, you can think about control as a way of investors who are typically minority investors. So as many of you know, venture capital firms are all about taking a minority stake, and private equity firms are all about taking majority stake. In order to further compensate the lack of control for minority stakes with venture capital funds, they have a whole bunch of quite interesting perks, which I'll run you through in just a second. So I think a lot of these make sense, and I'll tell you what's market and what's not for each one. So anti-dilution provisions. The objective of a anti-dilution provision is simply to provide protection for investors on down round. So you'll recall that I talked to you about the biggest protection, which was a non-participating one-time liquidation preference, which just means they get their money back first if there's a valuation lower than the current round. What this means is if you raise an amount of money at a lower valuation, then the investors who invested at the higher valuation simply get compensated. And they get compensated typically by more shares. And those more shares, the market measure for those more shares is a broad-based weighted average. And the broad-based weighted average method simply is a function of the valuation currently and the valuation of the higher round beforehand. And so you can think of this as if you raise at a 5 mil val and then a 3 mil val, and an investor has a 20% stake at a 5 mil val because they invest 1 million, you're effectively giving them more shares when they're raising, when you as an entrepreneur are raising a 3 mil. And the measure of who benefits and who doesn't benefit is determined by the method that's used to calculate that metric. The market practice is that both you and the investor get hit by this metric, but of course there's a long tail of options where you as an entrepreneur, what to look out for is the full ratchet, whereby you take all the hit. Of course, on the other side of the scale is where the investor takes all the hit. If the investor takes all the hit, there is no anti-dilution provision, and typically if you and the investor take a hit, then it makes sense for the investor to put in an anti-dilution provision. This is fairly market standard, and I think makes sense. You know, if you're raising it around that's too high, and then you then raise it lower round, you're effectively damaging the investment that the investor put previously in, so they effectively get compensated. A couple of other ones, preemption rights on new issues. So preemption rights in plain English simply means that if you're asking for additional capital, your existing investors get to simply invest at the additional valuation, which I think makes sense. You know, they've taken a risk, and all you're doing is you're offering them the opportunity to follow on. Super pro rata right on new issues is a little bit more tricky. What that means is that if you're going out to the market and you're saying I'm raising another 2 million, what a super pro rata right means is that as well as their preemption right, the investors get an additional right. They get to say, you know what, we'll take the whole round. And if the investor says, you know what, we'll take the whole round, I can tell you that's a very bad signal for when you're looking to raise with new investors. Imagine the case where you as an entrepreneur, you spent 2 months negotiating your term sheet with the investor. This new investor says, I'm ready to commit. You announce to the market that you're raising 2 million or 3 million or 5 million or whatever the amount may be. And your existing investors say, you know what, we'll activate our super pro rata right. That will not end well for your investors who have currently dedicated 2 months of diligence. And so that is a particularly sore, sensitive topic and something for you to negotiate with. Your argument for investors? Well, your argument to investors, if they're big top tier investors, simply listen. If you put this issue in there, it will reduce our chance of raising Series B money, and you'll then reduce your chance of getting an increase in valuation. It's a fairly simple argument. Preemption rights on share transfers. In plain English, that's in transfer. If an entrepreneur leaves, if the founding team leaves, then what happens is you offer those shares out to your existing investors and your existing shareholders. Very simple. Pay-to-play provisions, what that means is you're effectively punishing your investors if they don't follow on. The most simple example of this is, say you received funding from an investor, and that funding that you received, the existing investor did not want to follow on. In very simple terms, why doesn't that existing investor simply use their preference to follow on in the future? And that could be written into the agreement. Ollie is asking, do you know if the market standards regarding liquidation preferences are roughly equivalent or more aggressive for US? US deals, and Europe typically follows the US a couple of years, or it's always like, 3 or 4 years behind. What happens normally is every time there's a recession, these things come up. And every time the market is going well and it's very competitive, these things come down. And so typically you're seeing a lot more of these preemption or a lot more of these control mechanisms when things are going badly. And in the US, I think there's now that the market's a bit more mature. So the participating preference and liquidation preference of more than one times is very rare. Whereas in the UK, a lot of the venture money that comes in, and you'll recall if you were listening in yesterday, the VCT and the IS money, all of that money that comes in is tax efficient money, and now they are looking to protect themselves even more, and therefore they are more likely to put in downside protections. So your mid to top tier UK and your mid to top tier US VCs are very similar in market practice. Your VCT and IS have additional downside protections, and then during a recession, these tend to be more aggressive. Someone else, I won't name names, I'll try and keep this anonymous from now on. Someone else asked what % of UK EU term sheets actually have participation preferred. So the answer to that, there's been a bunch of surveys from a number of organisations. Our view of this, having seen a whole bunch of term sheets in the last couple of years specifically on this point, is that the majority are one-time non-participating, with maybe 5 to 10% with this increased participation. Right, next up is another sensitive topic. This is probably the biggest area of sensitivity for entrepreneurs. Rightly so. You've spent 3 years building a business, and then someone comes in and says, you know what, you don't own any of it. Without understanding the logic, it makes no sense. So I'll explain to you the logic now. If I'm an investor and I'm investing a couple £1 million in the business, or even £500,000 in the business, and you then later on decide to leave, I'm a bit screwed. I've invested a whole bunch of time in you. You are maybe a key person. You as a founding team are probably the people that are driving the business. If you then go on to leave, how the hell am I going to find another founder if you keep your 20, 30, 40% shareholding? And so the reverse vesting, the objective of the reverse vesting, is effectively an insurance policy for me as an investor. And it makes complete sense. I do not want to be putting some money in a business where the founder's about to leave and I have to parachute in a CEO. How can I possibly parachute in a CEO if there's no shares left to give away? And so the objective of this, and what happens in practice, is simply that investors come in and say, you know what, entrepreneur, please can you give some of your shares back to us, and we will give those back to you over a period of time. And the market practice for this is 4 years with 25% of shares vested up front, i.e. if you have 50% shareholding, we'll give you 25% as an investor straight away, because that's fair. You can keep 25% of your shares that you've already worked hard to get. And what we'll do is every month, we'll give you some of those shares back. And if you're committed, if you see this as a 4 to 5 year play, then you shouldn't see any problem with that, because you're committed into the business. Psychologically, it's hurtful. Psychologically, it doesn't make much sense. But logically, for the investor, it does. And it makes sense, because if you leave, the investor will have to find someone else. Good and bad levers. Top tip here is to ensure that you work with a good law firm, and we can recommend a number of law firms if you drop us a note. My email is jonathan@mountsideVentures.com, and we're happily recommend you a bunch of law firms that can support and who have got a lot of experience doing seed and Series A deals, because this is a very good topic to actually ensure that you have a good law firm to draft your equity documents really correctly. So good lever and bad lever, that in plain English simply means that if you leave to start a competitor, if you leave because not through death or illness, if you leave because you've got a gross misconduct or fraud, you simply lose some of your shares. That's all it means. And it makes sense. It's logical. The debate comes where how you negotiate the good lever and bad lever, and how you define the two terms. And that's when you need a good lawyer to discuss. Drag along rights and tag along rights, these mean are simply it's a protection. It's a protection for the upside for both majority or minority investors. In plain English, drag along rights is if a whole bunch of shareholders want to sell their shares, they force the angel to follow on, which makes sense. If there's an exit of 50 mil and there's an angel that holds 2 to 3%, and they kick up a fight and they say, no, we don't want to sell the business, it might be worth 100 million, but the majority of shareholders want an exit, they force the angel to follow on. And it's, they force them, but they also compensate them with their equity stake. The tag along rights is the opposite. If a shareholder wants to sell their shares to a buyer, and actually the buyer is looking to buy a whole bunch of shares in the business, then effectively what that means is other shareholders can require this buyer to buy the shares as well. So it's an additional protection for the minority shareholders. So in plain English, if a company is being sold and there's an angel that has 5% of the business and everyone is leaving, that angel isn't going to be left behind. That VC isn't going to be left. But if you as a founder decide to sell your shares, you can't just say, you know what, we'll exit at 10 mil, we'll take our 75%, we'll take our 7.5 mil, and we'll just leave the angel within the business at 5% of whatever the value is, which again makes sense for the minority investor. So you can see that when you understand the logic behind a lot of these terms, a lot of them are logical and a lot of them make sense. It's the debate comes, for example, when you're talking about founder vesting, how many years and how much do you get up front? The debate comes when you're talking about super pro rata, whether the extent to which that will impede your chances of raising a Series B round. Warranties, the objective there is simply to protect investors from problems with management. So, plain English, you come in, you get an investment of a couple million, you forget to tell them you had this disgruntled employee who's suing you, you forget to tell them that you had this massive liability of £2 million. If you forget to say that and the investor invests and later find out that you hid that on purpose, then there's a problem, either fraud or simply you get penalized. And typically market practice for warranties is 1 times annual salary of the CEO. Anything above that, anything below that is non-market. So if it's 2 or 3 times, you can probably look to negotiate that a little bit lower. Someone asked if there's a market norm for how much equity an external CEO should be given to make investors comfortable. Yes, 10%. I think a couple of examples we've seen it is if an external CEO comes in at 10%, then that is sufficient incentive. And the way to structure that deal, if there isn't a 10% share equity available, is simply via share options, which is the way that I've seen it probably in a couple of times in the last year. Someone else asked around board seats. We'll get to that in just a second. Board of directors, we'll get to that in just a second, this very slide. So board of directors, what's the logic behind board of directors? It's just an additional investor protection on business decisions. They require typically a minimum number of board. Market practice is anything from once a month to once a quarter, and also 1 investor and 1 observer. Typically, that's market. If there's a co-investors or if there's more investors, you might want 1 investor each. If there's a small family office that gets in there, they may argue, but you'll probably want to push back to ensure that you don't have 3 investors, 1 or 2 founders, so you have an imbalance in the boardroom. That's probably what there is to say. Investor consent, there's a whole bunch of additional research, and the way we work with companies there's a whole bunch of analysis that we do with investor consents with startups. We haven't got time to cover all that in the detail, but the very high level is investors come in with a whole bunch of lists. Some of them are market, some of them certainly aren't, with things that you can and you cannot do. You can think of them a bit like a veto right. If you want to do something, the investor has a veto right to say yes or no. Deal conditions. Deal conditions are it's our way of thinking, and you won't see the word deal conditions in the term sheet, but the bucket that we've put some of these items in, the way to think about it is things that need to happen for you to get the term sheet, things that need to happen for you to actually sign and get the money. And I think these can be broken down roughly into 5 categories. The first one is diligence. So diligence is normally what needs to happen before you actually receive the funding, and requires maybe anything from a couple of weeks to a couple of months. And it's commercial diligence, people diligence, financial diligence, technical, regulatory. If you're a fintech business with FCA regulation, it's compliance. It's have you got the necessary GDPR in place? All that good stuff. Investors will say, great, we'll invest a couple of mil, subject to diligence. Next one is a sneaky one, subject to investment committee approval. We love your business, you're fantastic, you've grown, we love you, we're ready to invest. However, there's a slight bugbear of ours, and actually what that means is we need you to be approved in the IC. Typically, what that looks like is they need to get their, and you recall yesterday I talked about how VCs manage other people's money. It's not their money, it's other people's, and therefore they have to convince a separate committee to get involved and actually commit to investing in your business. And that's what the IC does. It's a bit of a kind of guarantee for the investor to pull out if they need to. But typically, most investors don't put it in there to pull out. They simply put it in there because it's a formality they need to go through. And what you want to do as entrepreneurs is really ensure that before you sign the term sheet, you've got a pretty good idea whether the IC is going to agree. Revenue assumptions. This is where if you're raising a Series A deal and you haven't yet hit that magical number of 1 million run rate, and you're on 600K and you've got a couple of key clients about to convert, the investor may put a 1 million metric in there and you have to hit it. And if you don't hit it, you'll probably have to renegotiate your term sheets with them. Share option schemes, market practice between 5 to 15%. They may look to put in a share option scheme in there in order to ensure they sufficiently incentivize your existing employees. Makes sense. If you're the founding team and you've got a bunch of employees and you want to make them feel motivated, you can give them sales commissions, sure, but actually share options is a really nice way of getting them committed. And it's one of those things that if you offer someone a small bit of the business, even though on a commercial perspective that value might be quite insignificant, from a psychological perspective it has a big impact on the way they work, on their motivation. Tax compliance comes in for EIS and VCT funds typically, and it simply means make sure that you've got advance assurance for EIS for UK companies. For non-UK companies, there's all sorts of different incentives and all sorts of different structures in place. For example, in Germany, there's the equivalent of EIS, and they will have their own tax efficient schemes and their own compliance. Binding terms. Binding terms are effectively the bits in a term sheet that are legally binding. And we've seen out of the few hundred odd term sheets, four key sections. And I think they're all pretty reasonable. Exclusivity, i.e. don't talk to someone else when you're talking to an investor, unless it's a co-investor, which makes sense. Typically market 30 to 90 days. Costs incurred. This is a punchy one, but I think it makes sense for some investors. Costs incurred means that if you go and discuss your term sheet with an investor, and you pull out, not because of the investor, but because you've decided to go with someone else or whatever it may be, and the cost incurred, think about cost incurred as like a protection for exclusivity. Because if you break exclusivity, what's the investor going to say? Oh no. We'll sue you. Good luck. But what they can say is, we won't sue you, but you've signed a contract saying you'll pay us 20 to 30K or whatever the cost may be up to when you pull out, and that is your cost incurred paragraph. Confidentiality, you can share the term sheet with your advisors, you can share it with management, and you can share it with company representatives. And then governing law simply means that where you're in, the jurisdiction that you're in, if there's a dispute, it's for UK, it's the UK courts that will settle the dispute. Someone's asking if term sheets are binding. So the only binding terms of a term sheet are these 4 points. So these 4 points are binding, i.e. you cannot go out to an investor, there will be a cost implication, you cannot share your term sheet, and the governing law is the UK. But the actual decision for the investor to commit to you in the investment is not binding. These are the only terms that are binding. So no, investors can pull out and you can pull out. But if you pull out, you get hit with costs. If investors pull out, investors pull out. They get bad rep in the market. We probably won't decide to work with them, and we won't then introduce the companies we're working with them. And there's a bit of fear in them knowing that, we may not, from our initiatives looking at supporting them with limited partners, we may then not look at to introduce them to our own investors, and they'll probably just be shut off the deal flow that we see. And there's a little bit of, there's a bit of incentive to behaving well. Yes, the video will be accessible after this session. Is it market practice for share option schemes to be diluted as part of further raises? Yes, in the sense that everyone gets diluted equally. So if you're raising additional amounts, everyone just, you're bringing additional investors in, everyone gets diluted. Is it market practice for investors to ask for costs irrespective of whether the company walks away? Yes. So it's market practice for those investors that have got the slightly the tax efficient ones. Remember, there's a divide in the UK. There's your top tier investors and there's your tax efficient investors. It's market practice of tax efficient investors to ask for and to put in this cost paragraph. Absolutely. For your top tier ones, they know that you're the best entrepreneur. They know that you might go for an index or a Boulderton, and actually they can't possibly commit to some cost implications. Let me know if that answers the question or not. Right. We've got a couple of minutes left, and this is the other terms. This is my favorite part of the term sheet. This is the first bit of my favorite part of the term sheet, the investor love letter. Now, the investor love letter is it's typically a one-page document when you receive your term sheet, which is your declaration of love from the investor to the investee. And it normally reads along the lines of, we love what you're doing. These are our companies in the space. This is what we've done for them. This is how awesome we are. Remember, there's 4 things that are legally binding. Their love letter certainly isn't one of them. And it's a sale document. So just bear that in mind. Information rights. Typically, investors want access to your financial accounts. You might have to have an audit. You might have to produce quarterly management accounts, and you may or may not decide to do or haven't done before. A timetable. They might say, we'd like to finish in December 2020. We'll aim to finish in. You might argue, to push that forward, to push that back. But normally there's a proposed timetable. Expenses relating to the investment. So expenses relating to the investment typically looks at in the form of a document which says there will be legal fees, there will be diligence fees, and we will recharge those to the company. And they will be within the amount that you ask for. And that's market practice for a lot of the tax efficient investors. Sometimes the top tier VCs don't put this in there. They just, it's part of the cost of business. And then the last clause is something that we've seen fairly recently. It's a clause in 2020 of, I think Q1 of this year, a whole bunch of investors, 20 or so investors got together and said, you know what, let's do our bit to save the planet. Let's stick a sustainability clause in there, which effectively says that the entrepreneur or the founding team have to consider the impact on CO2 emissions, the impact of their travel. Easiest thing to do there is, you're currently reduce traveling, which is a nice way of helping the planet currently. How common is bootstrapping, giving founders and key management something back? How common is bootstrapping? I'm not sure what you mean by that. Maybe ask again. Bootstrapping is when you're not giving in, you're raising investments without giving any equity away. Sorry, when you've got a business without actually having taken funds. I'll let you clarify the question a little bit. Where can you find term sheets? So this is the last slide. Let me check, see if Anthony's around. But before we jump on, I guess the conclusion around this is where can you find term sheets? So you can find them on the BVCA website. These are investor friendly. The BVCA is the body that works for the investors, and so clearly the investors are lobbying the BVCA to provide investor friendly terms. Some VCs share them on their websites. So Passion Capital share term sheets on their site. Kindred Capital share it on their site. Of course, Anthony, who just popped in, Seed Legals have got term sheets on their site. I think you go through their process and you become a client and you can access them, or you can speak to one of us and we can give you a bit more information as to what term sheets look like. So to summarize, these are the 5 sections we've gone through. Price is the most important. You've got your valuation and your term. Often there's preferences or not. Control is all about these minority investors who want a little bit of say in the business. I've taught you through all the typical rights and the provisions, and hopefully you've seen that a lot of these are logical. A lot of these, the preemption rights, the pro rata rights, all of these are fairly logical for investors to ensure they minimize their downside risk. The deal conditions was all about the things that you need to tick off before getting your money, getting the IC, getting the DD. Binding terms, those 4 key terms that when you sign the term sheets, you're legally bound by. And then other terms, most interestingly, is the investor love letter, where they declare how passionate they are about investing in the business. Cool. So that's the end of the workshop and the overview on term sheets. I hope that was helpful. If there's any additional questions, just whisk them over and we'll be happy to answer them. Now I'm delighted to introduce Anthony, who's the CEO of Seed Legals, to talk a little bit about what he's seen in the market. And maybe, Anthony, you can start by introducing yourself and I will exit from video.
All right. Hello, everyone. So my entire talk was taken. I mean, that's exactly the talk I do about deal terms and so on. So what I'm going to do is instead, I'm going to go through the life cycle of a company and then everything to do with fundraising, and then talk a little bit about fundraising in the time of coronavirus. So hello, everyone. I'm Anthony. I'm founder and CEO at Seed Legals. I used to head up BBC iPlayer. After I left the BBC, I built a startup, sold it, built a startup, sold it, invested in a few, got tired of paying law firms, met my business partner, Laurent Laffy, a genius ex-VC and serial angel investor, and we got together and decided to change that. So Seed Legals is a platform that 24/7 you can go to for all the things to build your business, whether it be share option schemes for your team. We think we're doing about 25% of all EMI schemes in the UK now. Raising investments, something like 1 in 10 of all UK funding rounds now happens on Seed Legals, SEIS, EIS, and more. But what I wanted to do is from that, share the experience that personally I've had and that we see on the platform. So many of the things I talk about, if you go to the Seed Legals website and you see resources, deal data, you'll see graphs showing or backing up the things we've suggested, and some of the things that Jonathan's mentioned about the percent equity that investors or advisors and so on get. You'll actually see that backed up with data. So if we go to the beginning, I think that the life of a startup is, if I can get a bit existential, like dropping a stone into a pond. And over 3 ripples, that is 3 investment rounds, you now want to get to either steady state, so you never need to raise again, or you can have an exit. And your goal is, at the end of 3 ripples, in each ripple, your personal influence diminishes, but your sphere of influence increases as a founder. Each time you're going to get diluted, and your goal is, after 3 rounds, potentially, you're going to still, the founders collectively, have more than 50% equity in the company. And for that, we see, amazingly and coincidentally, that each round, the median amount of equity dilution, the amount of equity you're selling in a round, is 15%. And what's interesting is, after 3 times doing that, if you dilute 15% times 3, or 0.85 to the power of 3, and you create a 10% option pool to give options to your team, at the end of that, you still have more than 50%. So I think the life of a startup is something like this. A couple of founders, statistically, it's 2 usually, get together, have an idea, and nobody invests in a PowerPoint. So you have to put some money into the business yourself in order to create something that would be investable. And we see founders putting a median of £26,000 of their own money into the business. How do we know that? Because on Seed Legals, in the term sheet, you can say, I'd like to repay my founder loan, and that's the median, £26,000. So that's the dropping of the stone into the pond. And then your first round might be raising 50K, friends and family, or it might be straight to the next step, raising £150,000 SEIS, your standard first UK funding round. And then you might be looking to raise 500 to 700,000 pounds in a seed round. And then you might be looking to raise £1 or £2 million in a Series A round. So each time you're looking to raise 3 to 5 times the amount you raised last time at 3 to 5 times the valuation, such that by the third time, you either don't need to raise again, or your business is ready for an exit and everyone benefits from all the effort they put in, and the investors make a nice return on investment. Now, obviously, that's just, an aspiration. There's nothing fixed about it. You might skip the first few steps if you put more money into the business. You might do more than 3 steps. You might find businesses raise a lot. Now, one of the things that Jonathan mentioned, or the questions, were about preference shares. So I'll hop very quickly into that, which is, the founders, your goal, of course, is you're putting a lot of your life and effort and into the business. Initially, you're not making any money. You're probably funding it yourself. So obviously, you're looking for return at the end. And what usually happens in the UK, because SEIS and EIS requires the investors to take what's called the ordinary risks of an investor, everyone has ordinary shares. Now, investors will often ask for preference shares once you get to a VC stage, or you get non-UK investors, where the norm in other countries might be preference shares. So one of the things with preference shares is that the investors on a sale of the company get their money back first. And this is the investors saying, yeah, I'll buy into your crazy valuation, it's fine. But if you sell the business at that valuation or a low valuation, I'm going to get my money back first. And the challenge is, if you have an exit for 100 million, it makes no difference if you've given your investors preference shares or not. But if you sell your business for a few million, which for you as a founder might be a fine exit, if you have preference shares, you may find yourself getting no money. So it's something to really look out for. And the high point or low point of this was a UK esports company, FanDuel, that sold the business 2 years ago for $500 million. I mean, that's awesome. The founders would have made a large amount. Amazing, big success story, except that the investors all had preference shares and they'd raised $500 million. And as a result, the early investors with their ordinary shares and the founders got precisely zero. In fact, the investors, the buyers, wrote them a check for $100 each, as I understand it, which seems a bit of a slap in the face, to compensate them. So what I'm going to do now is I'm going to turn on screen sharing, and I'm going to take you through my application window and my PowerPoint. Great. So I'm going to take you through very quickly the set of things to create the business, get funded, and then, of course, Jonathan would have deep dived into particular things around the term sheet, which I won't go into, but let's go through the life cycle. So the first thing is a couple of founders get together and have an idea. Seed Legal's data shows that about 10% of the time in the first year or so, the founders split up. You don't see eye to eye, somebody's got mortgage to pay, things are taking much longer than you expect to get things together, and someone has to go and get a proper job. So what happens is, when you incorporate, you normally make sort of 100 shares on company's house, 50 shares each maybe, and then if a founder leaves and you don't have a founder agreement with vesting in it, which says if I leave I have to give back some of my shares, you've now got a non-performing founder with some fraction of the company's equity, and that makes you pretty much uninvestable. Worse, if you don't have IP assignment in place and a founder leaves, they might claim this is their idea. And of course, no investor will touch a business with such a dispute. So sometimes it's amicable and sometimes not. And when people hit us up on web chat on Seed Legals and go, my founder's leaving, what to do next? And our reply is, do you have a founder agreement? Great, do a share transfer for the number of shares that are specified at this time from their vesting. And if the answer is no, we don't, then you are now trying to trade on their goodwill and discretion to come up with some deal. But of course, you know, when you had bright lights in your eyes and got together to do the business and it had zero value, you could agree anything. But now the business has a value and there's maybe some animosity and water under the bridge. Agreeing at that time is difficult. So thing one is always do your founder agreements. And when you get to your first proper funding round with a professional investor, the first thing they're going to check is that the founders have agreements with IP assignment investing, and everyone who's worked on the project has signed their intellectual property to the business. So they're going to be looking for your company to have an unbroken trail of ownership of all code other than open source, where they'll check you've got the rights to it. So friends and family investors in early rounds wouldn't know about this, wouldn't think to check, so you may skip that, but you can be sure when you come to your first professional round. So when I got investment for my first startup some years ago, and I got my due diligence request from investors, it was quite an eye-opener because I had none of this stuff prepared. You have to go and chase out people no longer working for you to sign agreements and hope you could find them wherever they're in the world. And it took me like 3 weeks to do this. And then for my next startup, the first time, it took me about 3 days because I just had to rummage around in shoe boxes at home and find the agreements which I'd printed out. And now with Seed Legals, it took me about 3 hours, in fact probably less, because all the documents are on the platform. I just go share these with the investor, we're sorted. So you definitely want to do all of these agreements. So the next thing is about giving equity to your team, and we've covered this a bit earlier. So why would you give equity, shares or share options to somebody? The reason you do that is because what they're being paid is less than market standard. So if your team are getting market standard salaries, why would you possibly give them options? Well, you might do as a feel good, but as a logical thing, you would do it because they could earn more elsewhere, and so you'd want to retain them by giving them options or shares. So the first thing to know about shares and options is when the shares have got no value, you can happily give shares to people. That's why when you build the business, you get 50 shares or whatever it is each. But once the company has a value, you might have done a first funding round, or you might have a term sheet on the table, or maybe you've been trading. If you give anyone free shares, they're going to have a tax liability. And if they're an employee of the company, that would be a deemed benefit, and the company will be liable for PAYE, national insurance, and so on. So this is something that companies, if they haven't looked into it, have a very unpleasant surprise where they dish out shares to employees or share options without setting up an EMI option scheme. And then one day later on, when people have exercised their shares, or their share options, and they get a call from their accountant going, you seem to have these shares which are worth £50,000, or the company now collectively has given out hundreds of thousands of pounds worth of shares or share options without an option scheme in place, then they may have a massive tax liability. So rule one is you can happily give shares if there's no value to the shares, but once they have a value, you want to give out share options. And there are quite a few different types of option schemes, but they all come down to really two, which is one, if it's an employee, it's an EMI option scheme, which is a HMRC tax advantage scheme that says you agree a valuation with HMRC, and the employee then pays that valuation when they exercise their options, and neither party pays tax, not the company and the employee, other than the upside on the employee. So it's a really good scheme. And now there's some magic with that, because what you want to do when you create an EMI scheme is you want the exercise price for the employee to be as low as possible, because they're going to have to write a check for that amount to buy the shares. So you might have just done a funding round or doing a funding round, and you're telling your investors, my valuation's 5 million. And you want to tell your HMRC, my valuation's 500,000, maybe 100,000. And how do you achieve these two different things while not being dishonest to each party? And the idea is that when you do what's called your EMI valuation, you show HMRC that the shares or the share options you're giving your employee have lower or less or more restrictive rights than the ones that investors are getting. So they may get B ordinary non-voting shares with no transfer rights, and they have some minority other things and so on. And by putting together a range of different reasons together with a valuation based on the company's accounting rather than the blue sky that the investors are buying into, your goal is to get something like a 95% discount. And so we do all of that on Seed Legals. We do several per day of EMI schemes, and we have this amazing machine-generated letter created for HMRC that uses about 12 different variables so that you can tell your investor 5 mil valuation. HMRC actually 95% discount on that. So that's the do's and don'ts of giving equity to your team. And by the way, if it's an advisor or a contractor, in the same way they pay their own tax for their income, ditto, they will pay their own tax on any options you give them. It's their problem. And for that, you can't give them EMI options. That's only for employees. You're going to create an unapproved option scheme, and you might give them the right to buy their shares, exercise price. It may be a penny, great, but they will pay the any upside after that. So the next thing is what percent equity to give to advisors. Now, I'm not a huge fan of maybe the value that many people think advisors provide. So what I like to do is I like to think about it in terms of a cash equivalent. Because if you meet an advisor and they go, yeah, I'm going to be on your pitch deck, I'll provide advice, I'll do industry intros and so on, I want 10% equity. Well, is 10% a lot or a little? Should it be 5? Should it be 1? Should it be 0.1? It's really hard to know exactly what the number should be. So what I like to do is I like to equate that to a pound value. So if your company valuation is £1 million and your advisor wants 10%, that's £100,000. That's a lot for someone who's going to pitch up one day a month at for board meetings. But once you've thought about it in terms of the number of pounds, then you can go and you can agree what that might be. So £50,000, I can employ another developer 5 days a week or more to build my app. Would I give the same amount to an advisor to breeze in one day a month? Probably not. So maybe 5K a year, maybe 10. And then what I will do is I'll go, great, so that's 1%, and it's going to vest over a year or over 2 years. So in the same way, you never give your developer the entire annual salary on day one. They need to work for it. Likewise, when you give an advisor some shares or share options, you should never just give it to them. It should always be with a vesting schedule. So on Seed Legals, you would create a non-exec director or an advisor agreement saying, this is what you'll do for the company, these number of days a week or a month, and in return, we'll give you this number of shares or share options vesting over a year. And doing that is a really good thing to do because it makes sure that, firstly, the advisor knows that they're on point for something, and if they don't perform, they won't get their options or shares. And the second thing is things often don't work out and you want to terminate. And if you have quantified what the deliverables are, then you can terminate. So the next thing is now, you are now going to talk to investors. So you've put some money in the business yourself, you've got your early team on board, you've built some stuff, you now want to get investment. And the question is, what should your company valuation be? And now, of course, this is one of the most difficult problems that you face as a founder, picking a valuation. And there are several ways to do it. You can go to TechCrunch and you can look at the valuations, and then you can take a 0 off the end because they're crazy American valuations. Or you can go to a site like UK Tech News, where everyone says how much they've raised, but nobody says what the valuation is. So that's not really useful. Or you can go to your accountant, and your accountant will go, have you made any profit? And you go, no. They go, do you have any revenue? You go, no. They go, are you losing money? You go, oh, yes. They go, are you about to make any money? You go, oh, no. And then they go, so remind me why your valuation is more than zero. So that's no good at all. So the next thing you could do is you could use a spreadsheet, and you can model your future revenue. You can go, great, in year 1, I'm going to make £20,000, and year 2, I'm going to make $1 million, and year 3, I'm going to make 20 million, and year 4, 100 million. And I've seen spreadsheets that do that, and even more. And the problem there is, as an investor, I think those numbers are BS, because nobody makes those numbers. I mean, if you were to believe spreadsheets, many startups would by year 4, be FTSE 500 or FTSE 100 companies. So the future modeling of revenue and using that for evaluation, I don't think is useful. So what is the technique to use? So using data on seed legals over hundreds and now thousands of rounds, we've seen that companies give away a median of 15% equity in a round. And so that means that funding rounds usually fall into a few bands. If I go back to my Ripple theory, your first round might be raising, friends and family, 50K at a 500K valuation, or maybe 150K at an 850K pre-money valuation, or maybe later on £1 million at a £4 or £5 million valuation. So the Anthony technique for valuation says, because the data shows that you're selling a median of 15% equity, all you need to do is multiply the amount you're raising by 5, so the investor gets 1 in 6 of the total, which is 16%, to work out your valuation. So if you want to raise 200K, your pre-money valuation would be 200 times 5, $1 million. After the round, your post-money is 1.2 million, and the investor owns 200 out of 1.2, 16%. Now, of course, that just moves the problem space from the valuation to how much should I raise. So you also need to know, and you'll see this in the Seed Legals deal data section, which is that I think, sounds facetious, but funding rounds in the UK easily fall into a few bands, which is a couple of founders get together, have an idea, what's the valuation? 300K. We've got a prototype, 500K. We've built something and it's kind of live and there are a few users, great, 700K. We've got a decent number of users, but no revenue yet, great, $1 million. We've got some revenue, a few K a month, great, 2 million. And after that, your valuation is often a function of revenue. So in the early stages, angel investors will be buying into the team and the idea, and later on, VCs, of course, will be doing that as well, or at least telling you that, but often will be looking at simply the rate of growth, and in fact, they won't almost care what it is. If you show them the right graph, then they're in. And I love the articles that I see on Business Insider and elsewhere about this is the pitch deck that Airbnb or Uber or somebody used. Copy this. It's nonsense. When you look at those pitch decks, there's one slide in it which is the clincher, which is the rate of growth of revenue or users or market share or something. Everything else the investor completely ignores. So if you've got a graph that does this, then no matter what else, you could put smiley faces the rest of the deck. Nobody would care. And of course, your challenge is until you get there, how do you show that dream? So the next thing is, so on Seed Legals, if you want to do a funding round, the fastest and easy way, you get in on the platform, and pretty much everything and more that Jonathan went through of all the deal terms, you would actually go in and we take you through questions to go, do you want drag long? This is what it means. This is why you need it. This is the standard percentage. And then the platform will build all the deal docs. So you'll understand and be able to choose every deal term, because most times an investor or your lawyer gives you 150 pages of legals, and there you are trying to figure out what you're signing up for. And we'd look to invert that. But the other thing we're looking to do is show you not only how to do a funding round really efficiently, but how to do not a funding round. So let me explain. So what we saw on Seed Legals is that if I look at the chart that I showed you, the purple one, where back in 2018, we saw that companies were raising a funding round and selling a median of 15% equity in the round. But then we noticed that little blip on the bottom left of people doing small rounds. And essentially the way funding rounds work, and going back to the 3 ripples, is that in the past, when you do a funding round, you have to spend maybe 3 months finding investors. And then it takes you 3 months to close a round, going backwards and forwards with lawyers and all the legals and so on. So that's 6 months. And then you're raising enough to get you to the point where you can raise again later at a higher valuation and raise 3 to 5 times the amount. And that's going to take you at least 6 months to get the traction to show that something's changed. That's 12 months. But then you can't risk trading insolvent, so you need at least 3 months cash in the bank. So that's 15 months. And so because of the time and cost of doing a funding round, funding rounds in the past have been you raising enough to last 12 to 18 months. So you've got these big 12 to 18 month go big or go bust cycles. And as a founder myself, that's enormously stressful. You've got a million or millions or hundreds of thousands in the bank. That's awesome. Go. And then you start spending, and then month on month, the money goes down. There's no revenue, and you can just see the end, the wall coming up. And, it's hugely stressful. So why does it have to be that way? And then we found, thanks to seed legals, people were starting to do small rounds, raising small amounts, maybe giving away or selling a couple of % equity. So then we turned that into a product, and we took what's called an advanced subscription agreement, which is an SEIS, EIS version of a convertible note, which says, I give you money now, and you give me shares later when you do your next round at a valuation to be agreed later. We called it a seed fast. And seed fasts turn out to be insanely popular. So people raise 5K, 10K, 2K, 100K, and it's to raise money from individual investors ahead of a funding round. And then we found people were coming to us going, hey, I'm looking to raise 300K, but I've got 200 lined up. What should I do? Should I close a smaller round, or should I wait? And we'll get back to that in the COVID discussion in a moment. So after having this dilemma, telling people, you wait or close sooner with a smaller amount, we thought, why does it have to be binary? Can't we create something where you can do a rolling close round? And so we now, by default, in one click, you can say, I'd like to close 200K and top up another 100K in the next 6 months. And that's your rolling close round. And you can do these instant investment top-up or CFOS literally in minutes. And we've seen now companies completely change the way they do fundraising. So that purple curve was like so 2018. When we looked at our 2019 data, that's the green curve. And there's actually more money now raised out of funding rounds than in funding rounds. And I love it because I see on our Slack integration, midnight on a Sunday night, someone doing, a seed fast for 10K or 50K. And I'm amazed that there, as a founder, something you were never able to do before, which is get to the next step, on a weekend evening, because actually that's the only time you've got to do your accounting and legals and other stuff, to build your business. And so my goal is, interestingly, step 1 was to build a utility to do what you want more efficiently than law firms. But step 2 is to do the things you didn't yet know that you might want. So if I now go a couple of technical do's and don'ts. So when you go and talk to your investor about valuation, one of the common problems we see is that somebody goes, I'm raising 100K on $1 million valuation. Your investor goes, I'm going to get 10% of the business. But no, they're going to get 9.09%, because if your valuation was $1 million before the round and you're raising 100,000, it's now 1.1 million afterwards, and the investor earns 100 out of 1.1, 9.09%. So when you talk to your investors, always describe whether it's the pre or the post-money valuation. And by saying it's pre or post-money, you're doing a few things. Number 1, you're showing the investor that you know what you're talking about, so they're not going to try and pull a fast one on you because you know your stuff. Number 2, you're being open and transparent, which is good in the relationship. And number 3, some investors know all this stuff, but many SEIS, EIS investors don't, and they may be embarrassed to ask. So by showing them this and imparting knowledge, you're helping build them as an investor, and that's a great way for them to buy into liking you, trusting you, and wanting to be part of more later. So then the question is, should you talk about pre or post-money valuation? So if you think about it, the pre-money valuation is the valuation you've decided it's going to be. Now, of course, you might change that as you talk to investors. You may get feedback to go, guys, your valuation's insane, make it lower. But broadly, pretty quickly, you'll come up with a number. The post-money is the valuation after the investment. But the thing is, as you change or add investment or decide I'm not raising 300, I'm raising 200, your post-money is a moving target. And investors don't like moving targets because the amount of equity they will have if you're changing the numbers is going to change. So I always recommend, always talk about a pre-money valuation so that if you do decide to change the amount you're raising, maybe you can't raise everything you want, then the pre isn't changing and you don't have to keep telling the investor different numbers. So we've already discussed about giving shares when the company's got no value. When they have value, make sure you give share options and create an EMI option scheme for your team. So now I'm going to stop sharing, and I'm going to just spend a few moments on talking about coronavirus time. So, being a founder is hard. All of the things that, the weight of the business that you're carrying on your shoulders. As an employee, if you're bored, you can go off and do something else. You can go off on holiday. But as a founder, you can't just get people to be on your journey and then, if a couple of months in, go, I'm bored, I'm off to Mallorca, have fun. You have a responsibility to make it a success. So, you've got all of that and fundraising, and then comes along a pandemic. So I think one of the things when I look within, one of the key attributes I think as a founder is you have to be able to make decisions, and you can't procrastinate. As a founder, procrastination is kind of death. So, suddenly comes this a domain that you totally didn't know, nothing more than anyone else, and how are you going to adapt? And so I think what's interesting is with Seed Legals, we've got data for everything. And so one of the big questions, should I stop fundraising? Should I keep going? Should I reduce the valuation? And what we saw over many rounds is when April hit, we saw actually not a change in the number of funding rounds closing, but we saw term sheets getting signed with 30% fewer investors and companies raising 30% less. And so what happened is, if you have one VC in your round and they bail, the round's over. But if you've got a dozen angel investors and 3 of them bail, great, ditch them from the term sheet, keep going without them, raise less, and then use the rolling close and instant investment to top up more. So what we found is, firstly, we saw in April maybe a 50% reduction in the number of advance assurance applications. So we do something like 1 in 4 of all SEIS applications now in the UK is through Seed Legals. We do 6 or 7 per day, and we saw a huge decrease in that, which was essentially a leading indicator that people didn't have confidence that they would do a round later. But then that bounced back about a month later, and it's back up to pretty much where it used to be. And then we saw, rounds closing with 30% fewer investors and 30% less investment, but we didn't see a change in the valuations, at least not something we could detect, as significant. So I think that really sums up our position, which might be different in some VC-led rounds where VCs might be changing the valuation. So my take is, as a founder, procrastination is usually not a good thing. Well, sometimes it's good, but often it's not a good idea. And so my advice is just keep going, don't wait. And there's been all this talk about, it's going to take years for investment to come back again. Firstly, my data shows it's totally not the case. It's already bounced back. But secondly, I'm seeing on Twitter, US VCs, where essentially what's happening is the best companies are now raising as if it's business as usual. And therefore, the investors who want to be in on the best companies don't have an option. Either they're going to not be part of those rounds, or they're going to keep investing. So I see things for companies that are, either largely unaffected by COVID, as in SaaS businesses and so on, or ones who can pivot to take advantage of it. It's very much business as usual. Of course, if you're a gym, then it's somewhat more difficult. So that is about fundraising in times of coronavirus. Very briefly, I think then there's the question of the office. So, Seed Legals, we're now 55 people, actually growing. I've got 3 new starters on Monday, and of course, hiring when everyone's not in office is a problem. So I always assumed that sort of about now we would be back in the office. And the government hasn't been really helpful in sort of defining different levels of in the office or not. So I had to go and wrote a little blog post, and I called it WorkCon 1 to WorkCon 5, sort of modeled on DEFCON. And WorkCon 1 is you may not come to the office, you have to be at home. Office is no-go zone. WorkCon 2 is if you have to be in the office, okay, go there. That's not applicable for most startups. WorkCon 3 is, sure, if you want to be in the office, go for it. There's no expectation that anyone's there. And I would expect a few people who really hate being at home to be in the office. WorkCon 4 is where you're welcome to be in the office or not. And I would expect maybe half the team will be in at any time. And WorkCon 5 is kind of the way it used to be, where certainly for me, I love building a team where everyone's works together and plays together. And you would be expected to be in the office unless the boiler's broken, family thing, whatever, great. And the question is, will we ever be at WorkCon 5 again? So I expected very quickly we'd be back at 4, we'd all be back in the office. And then I ran a Slack poll for my team and gave them 4 options. On July the 6th, I want to be back in the office. Number 2, I'll be back in the office on July 6th if a good fraction of the rest of the team is there. Option 3, I would love to be back in the office. Give me a couple of weeks more. And option 4, actually, I never want to be in the office. I like it the way it is. And the numbers were about half of people went, I like it the way it is. I don't want to be back in the office. And the rest were fairly split. I think people with kids going, please, can I be back in the office? And others going, well, there's no rush. I'd like to pop in occasionally. Which then leaves the question of, do you keep your office space or not? So I've actually just canceled my office lease. The lease was up. I'm on 3 months notice. I have a very nice office, which I'm going to pay lots of rental for a space that I never use for the next 3 months. And then I totally don't yet know what I'm going to do. But since, procrastination is not an option, we have to do something there. And then very briefly from me, the last thing is, trying to run the team remotely. And of course, with 55 people, I was wondering, was it going to be a disaster? And it turned out the team took to work from home like ducks to water. They were delighted. Everyone was on Zoom. I think things were actually more efficient. Meetings start within a minute. It's amazing. There's no fighting for meeting rooms. And actually, things didn't fall apart. I think, as I can see, the majority of people have no great rush or inclination to be back in the office. I think the thing I did find is hard is product development. So when we talk to our customers, it's always on intercom or web chat or Zoom. And actually, we bought a Zoom subscription, coincidentally, a month before COVID hit. So that was business as usual. There's nothing like, staying in front of a whiteboard to do some product development. And that, you want to reach into the screen and do it. So there, that's the bit that's frustrating. But what I try to do is work really hard to try and make it fun for the team. What I don't want is somebody to be sitting at home, the only thing they ever hear is requests on Slack to do stuff. So how can you make people feel included and part of the team? So we have a Monday morning Zoom catch up. There's a mystery guest on it. I ping a few of the people beforehand who want to and are happy to pop on video and tell us what they've been cooking, what's in their fridge, what they've been reading. We have a fridge of the week where someone sends a photo of the fridge and we have to guess what it is. We have a Friday beers. And then I love supporting our customers. So when I see customers that have got things that are interesting, I like to buy them. So there is a company that does coronavirus masks, which actually look really good. So I bought 2 of those for each of the team and got those delivered. And then we have a Paul's next to our office, and I used to buy croissants for everyone. So I've ordered croissants and gave one of my assistant the unenviable task of arranging delivery for 50 people with croissants and bread. And boy, when those arrived, the smell of the croissant was amazing. So I really suggest that. And now we're doing a wine tasting where one of our customers has a wine tasting app and sells wine. So I'm getting 2 bottles delivered, and I've persuaded them to get on Zoom and do wine tasting notes for us, which we'll do sometime next week. So anyway, it's all about, making sure you've got a positive thing with your team, keep fundraising, and build team. And that was it from me. And if you've got any questions, I'll see if I can go through some questions here if we've got time. Otherwise, if we're on panel. But otherwise, yeah, you can hit me up at anthony@seedlegals.com for any questions. Thank you.
Hi, everyone. I'm joining the panel, so I think Olivia will be dialing in shortly as well. But while waiting, I'll do a quick intro myself. So I'm Alex Reed. I'm a partner at Mountside Ventures. A little background on me. I started at a specialist law firm who advised VCT and EIS funds, who Jonathan taught you guys through yesterday. Then moved to PwC. I'm also a chartered accountant. Spent 3 years in the investment management practice, working mainly on PE deals. Then moved to the innovation team. Helped co-found a couple of PwC startup propositions, and I ran the first FinTech program in London. Went on to do InsurTech as well. We did about 20 programs across the UK. And then I expanded these internationally, launching the Corporate Accelerator, then leading the early stage fundraising proposition in Berlin. So I've been living out there for the last 2 years. Main focus being supporting European startups fundraise. So I'm now back, co-founded Mountside Ventures with John and Jonathan, and I'll continue to focus on the European side, be it with startups or investors. So yeah, I know we're doing a little panel discussion, and Olivia, I don't know if she's dialing in, but it's probably worth, I don't know, Anthony, we could discuss a bit about the term sheet. So how about, yeah, it'd be great to hear what your thoughts are on how much detail to put in the term sheet.
Right, so that's a fun question. So I think term sheets are kind of like a first date. And the question is how much you talk about in detail of your future plans on your first date. So, some people, the sort of passion capital term sheet goes, we love you dearly. Yeah, you're awesome. Can we invest 100K? And by the way, we want some rights. But the problem is if you don't put very much into the term sheet, the advantage of a very simple term sheet looks great. We're going to invest 100K. The problem is there's a big sticker shock or disconnect later when you discover all the things that the investor really wants. And if you're only discovering it when they send you 150 pages of legals and you have to try and unpick it, that's really bad. So my business partner, Laurent, ex-VC, likes the opposite approach, which is a really full-featured term sheet where all the deal terms are laid out, and that avoids surprises later. And going to a dating analogy, that would be like your first date explaining you want a house in the countryside, 3 kids and a dog. Maybe it's a bit forward on the first date, maybe you'll put people off, but actually if you get past that point, it saves a lot of trouble later on. And so on Seed Legals, we found it's much better to have the debate on do you want preference shares or anti-dilution or other things at term sheet stage, because there everything's explained in plain English. Once you get onto the shareholders agreement and articles, the point of those documents is to take the deal terms and write it out in thousands of words of legalese. If you've transferred to the legal domain, it's a huge amount of effort. You're conflating an idea and legal language. You're much better off expressing the idea in plain English. And then in our case, the platform will literally within 1 second build all the legals to reflect that. So we like to have a comprehensive term sheet that that essentially has you agree every key deal point before you waste time and money on the long form legals.
Definitely. I think from our side, we definitely agree there. And if you have good advisors who know market, we'd definitely say put in as much as possible in the term sheet to save the time, the effort, and the legal fees further down the line. So agreeing all that commercial stuff up front, then the lawyers can argue about, where the semicolon goes later when they draw up the docs. And yeah, just getting the commercial stuff in there so you're comfortable and have clarity on all the potential scenarios. So yeah.
Thanks, guys. Apologies, I was late coming on. I was dealing with a spinning wheel of death on the screen there. But it's great to hear that on kind of how to get the balance right with the term sheets. I wanted to ask you both, what would you advise founders in terms of what points to push back on and what points to sort of let go? Is there any you've seen things being delayed by someone really clinging on to something? Perhaps Anthony could hear your perspective.
Great question. So I think what's interesting is when we started Seed Legals, my thought was I wanted an efficient way to get people who are going to consent to something to get together and agree things. And then as I saw lots and lots of the funding rounds happen, I realized that the most efficient way to close a round is when both people are closing at what's market standard for that size round, and market standard changes as you have a different size round. So the next thing I did was then have data and hint text to reflect market standard. So what I find is in the UK, serial angel investors are always looking for a standard set of things. If you have the shoe that fits, it works super easily. But sometimes people have just got outliers. They don't understand things, or maybe they're foreign investors and deal terms in other countries are different. Or the worst are friends and family who have no idea how equity raises work. And then we get to the gist of the answer. So what are the key things that are just weird that you should never agree to? The most obvious one is non-diluting shares. So actually, I saw on my Seed Legals web chat moments ago, somebody wants to give their team options that don't dilute. Or an advisor says, some family member, well-meaning one, saying, I'd like to invest in your business. I'll give you 50K for 10% of the business, but I want non-diluting shares. There is no such thing as a non-diluting share. If you give someone shares that won't dilute, it means you as the founders are buying more shares for them in the future, and it can be a hugely expensive mistake. So if someone's investing 50K, in your business, and you're giving them non-diluting shares, one day when your business has a valuation of 10 million, you're giving them like £1 million of extra value on every funding round. So never, ever give people non-diluting shares. The next thing is anti-dilution. So what anti-dilution is they're an investor saying, okay, I'm buying into your insane 3 million valuation. You've got no revenue, whatever, I'm in. But if you can't sustain that valuation in your next round and you now raise at a lower valuation, let's say 2 million, you're going to top up my shares as if I had invested at the lower valuation. So if an investor asks for anti-dilution, it's usually what means generally one of two things. Either that's just their standard terms, they're a VC, they always want anti-dilution, or it's a signal to you that your valuation is too high and they're not confident that you're actually going to sustain that in your next round. So one of the common mistakes I see is, founders, getting a little bit over themselves, ahead of themselves in valuation. And if you have a really high valuation, often crowd rounds at very high valuations, maybe the crowd investors are slightly more naive or buy into the hype compared to a VC who's going to buy into the growth curve. Then if you can't sustain that on your next round, you have a down round. So anti-dilution, if it's a VC who's asking for it, you probably are not going to be able to push back on it. But one of the joys of SEIS and EIS investment is the investors have to get what's called take the ordinary risks of an investor. So SEIS investors can't get preference shares or anti-dilution or non-dilution or promises of more shares in the future as a condition of investment. And as a result, SEIS is good, not just for the investor, but for the founder, because most of the egregious things that a VC might ask for will make you ineligible for SEIS. So if an investor asks for anti-dilution, you go, dude, you can lose your SEIS. You're much better off taking the SEIS. So non-dilution, anti-dilution are the key things. And then I think anything that's not market standard. So the last one for me then would be founders who try to do weird things to give themselves an advantage. So the founders might go, I'm worried about losing control of the business. So I'd like to make shares with 3 votes each, please. It's like, dude, you've been reading what Mark Zuckerberg's done. If you've got $1 trillion company, knock yourself out, do whatever you want. If you're looking for 150K SEIS, investors can go many, many places. Anytime they see somebody doing something that's either naive or to the benefit of the founder rather than the investor, they just look elsewhere. So essentially every single time we see companies that set up what I call alphabet shares. So they've got A shares, B shares, C shares, or shares with strange combinations of extra votes for the founders and not for the investors. When it comes to the first funding round, they always have to get undone, and it's a huge amount of friction. So you're much better off. Everyone gets ordinary shares in early rounds. Your employees get B ordinary non-voting shares, which gives them a better discount on the EMI valuations. And then investors get ordinary shares until you hit VCs, and then they're going to ask for preference shares. And that's the fundamentals of the funding round.
Thanks, Anthony. And Alex, have you any experience there with things maybe being stalled by people clinging on to different details?
Yeah, I think there's just 2 points to actually add on the negotiation and what to push back on. Firstly, I think there's certain points you need to clarify. So I guess a short example, the bad lever. So it often says, it's in line with our standard provisions. But one point to clarify, not necessarily negotiate, is find out what that standard is up front and pin them down to it. So you know what you're getting yourself into. And then on the negotiation side and what to push back on, there are some investors who have certain red flags on what they just won't budge on. So, for example, if we stick to the EIS and VCT side, they make their money off the arrangement fee, so 2-3%. And it's rare they'll ever negotiate a lower arrangement fee than that. So instead of negotiating down what you're paying on these costs, instead you could gross up what you're asking for. So there are certain sticking points to be aware of before you go in and try and negotiate every term in that term sheet.
Sure. And someone's actually, questions just come through from the audience. Would you advise a founder to work with investors who really understand your business, even if it's a low valuation? So I guess, what do you look for in an investor?
I'll hop in there first. So the way I interpret that question is, as an investor, you want to raise at £1 million valuation. The investors come along and said, tell you what, I would like you to make it $500,000. So in other words, I'm going to get more equity because I'm going to give you all this valuable advice. And my thought there is, I like to, in my mind, keep 2 separate roles, investor and advisor. An investor, I would love to take your money and use it to build my business. I can't get rid of you. I've taken your money. I have to make it perform. As an advisor, I'm giving you something in return for advice. And if you stop giving me advice or I don't need it, we're going to terminate. So if you conflate the two and you're giving the investor, shares as being an advisor, you can't undo that. It might turn out that you've given them, 5% of your business, and actually they had no useful advice and you can't get rid of it. So I'm not a fan of those arrangements. And instead, what I would do is I would say, great, as an investor, I would love to take your investment at £1 million valuation. And separately, as an advisor, I tell you what, I'll give you, a few percent equity. For tax reasons, you probably want it as options, not shares, but with a vesting schedule. So if it doesn't work out, those stop. You only get some fraction of those according to what you've done. And by the way, that's often a disguised way of giving someone a better valuation in a funding round. So you may have a funding round where you've set a 2 million valuation, and there's one investor who insists they will only invest at a 1.5 million valuation. You can't really, well, you can give them a discount, but in the term sheet, everyone will see, hey, this person's paying less for their shares than me. And that's, of course, then leads everyone else to say, can I also get the low valuation, please? Why did Jones get it? So the way you get around that is everyone comes in at the same valuation, and then one person, you call them an advisor and you give them some share options on the side, and that's kind of, invisible to others, or at least you can justify it that they are there as an advisor. But again, I would start by saying, in my mind, there's a role of investor and advisor, and I like to keep them separate.
Sure. And we talk about, sorry, Alex, go ahead.
So I was just going to add that, it's a common theme we see that founders getting too caught up in that valuation when they're raising. And they shouldn't be. What they need to focus on really is their return profile on exit. And that's something Jonathan talked about earlier with the preferences. I mean, you can get any valuation you want by increasing your liquidation preference. But that's a common thing we see a lot. People, whether it's ego or another, that they see their business valued a lot higher than often investors do.
And Alex, in terms of having competition, different investors involved, how would you create positive competitive tension? And when do you sort of introduce co-investors to each other? Any tips for that? Yeah, no, it's definitely a case of the more players in the game or horses in the race. That's how you increase the competitive tensions. We often set deadlines. So, say all term sheets in by 2 weeks' time before moving to the next stage, which gives the competition. It shows that sort of more than one party's involved, even when there's maybe not. And then on the co-investors, when you introduce them to each other, I guess it depends. So before term sheets are signed, but obviously far enough along that it doesn't impact the deal. So as a startup, you'd want to play them off against each other, be in control of that, and maybe try and level out the term sheets that you've got on the table. I've actually had a startup I work with over in Berlin who introduced them pretty early on. They had very different valuations on the term sheets. And we said, don't introduce them. They thought, let them talk. And they ended up dropping the val, aligned on certain terms, and actually any negotiation position for the startup.
Yeah, so my business partner is actually quite adamant that the investors shouldn't know about each other in the early stages because they can collude. And so he would look to keep them apart. But I think funding rounds generally, are in two categories: angel rounds and VC rounds. And angel rounds, you as the company will lead. You'll get on seed legals, build your term sheet, and send it out to a bunch of angel investors. You can set the term sheet to hide the names of the other investors so they can't see each other until the time comes to sign. But in an angel round, you might have, 3 to 30 investors in the round. And you as the company are leading with a term sheet, and then you may negotiate individually, but you're driving. When you come to later stage rounds, the investor might send you their term sheet. And now you've got this weird thing of having sitting on the kitchen table with all these different term sheets with slightly different language, trying to work out what everyone wants. And that's the next problem I'm looking to solve, which is, in fact, on Seed Legals. We're about to launch Seed Legals for investors so they can send term sheets through Seed Legals. And then you'll see a comparison of the deal terms. And, I want X, you want Y. And then when you close it, you agree, then you move on to the completion of the legals. But that's the next challenge to solve.
Sure. And what's a kind of good timeline to expect for getting the term sheet signed for those who haven't done it before? And has that kind of changed at the moment due to COVID-19?
Alex?
Yeah, I think probably 2 to 3 months, but it depends. We heard from Nick from Octopus yesterday, who talked about their process and how I think they doubled their meetings. So instead of doing 3 meetings in person, they did it 6 or 7 times on Zoom. So yeah, it's harder to build relationships. It's harder to make that progress that you might have done pre-COVID. So I think timelines, if we're realistic, are extending.
I think there is a difference between angels and VCs are painfully slow and may mess you around for months, whereas angels will make decisions within days or weeks. And so very often we'll see a funding round which has got the company can raised from a VC or a bunch of angels, or maybe they've got half the amount in angel investment and half of it from a VC, and the angels are, 3 weeks in going, dude, we've signed, can we just close? And the VC's still doing meetings. So you may find that at least in earlier stages, you may be better off looking for angels if you're looking to do something faster.
Sure. We have another
don't have investment committees. Yeah.
We have another audience question here. Someone says, we've bootstrapped for 2 years. How do you think investors view this? We had assumed it would be a boon, but that's not always been the feedback we've had. So what are your views on that?
I'll go first. So the reason you've bootstrapped for 2 years can be one of several reasons. Either it was a hobby and actually you had a real job during this time, so it indicates that you weren't in any particular rush, and now why is that changing? Number two, it might mean that you were risk averse or something like that. But my business partner reminds me periodically that as a founder, you can't own more than 100% of the business yourself. So at some point, pretty soon, it makes no sense to keep putting your own money into it. So the purpose of bootstrapping is to raise the valuation to the point where it now makes sense to raise the amount you want at the valuation you can achieve, so you don't have to keep putting money in. So when the person bootstrapped, the question is, did they put it 5K or did they put 500K? If they put 500K, that's very nice. They're independently wealthy. It might, if they're looking to repay their bootstrap investment, then that would be negative on their investability, because the investor would go, wait, all this money I'm investing isn't going to grow the business, it's going to give the founder their money back. If you put in 20K of your own money over 2 years, sure, knock yourself out, repay your founder loan when you get to cash flow break even, it's going to be a drop in the ocean. So, I think if you've been bootstrapping for 2 years, I think if investors are pushing back on that, there's something else at play, that either they think it's a hobby or, it looks like it's just not ready for funding yet, but I wouldn't otherwise see any issue with it.
Sure. Alex, would that be your view?
Yeah, we think it's great. We love startups that are bootstrapped, who haven't already been round the houses to all the investors already. So when we take you out to market, it's a fresh new proposition, and I definitely agree. There's probably something else that maybe they're not telling you, and that's the feedback they've given.
And what kind of, we've obviously heard from the advice on the Seed Legal site, and there's some content on the Mountside website as well. But for those who are just starting to go through this process, what kind of support is available, and when should they seek advice on the legal side of things? What's out there for them?
Yeah, there's a ton of stuff online, like you said. A lot of it can be outdated and maybe not current and not market. There's obviously people like us. There's lawyers who I think it's best to get ones that know Series A. There are a bunch that do that well. And I think, there are some lawyers who can make some intros to investors. They'll charge quite a high fee on the negotiation side. And that's why at Mountside, we've tried to align with founders on risk and sharing that by working just on a contingent fee basis.
My take with my Seed Legals hat is Seed Legals is your one-stop shop. We don't do investor intros, so that's exactly where you go to someone who's going to do that. But in terms of all the legals, I like to think about what law firms do and then do exactly the opposite. So there's unlimited help and support at zero cost. There are articles, there's data. You can hop on the platform 24/7 and do all those founder agreements, build your term sheet. You're empowered and you're driving. So my goal is to completely change the process so the founders, have a one-stop platform to do everything.
Do you think?
Sorry, no, go for it.
Do you think doing that through technology really does empower people who may otherwise have been maybe overwhelmed by the process and wouldn't have known where to get started?
For sure. And when I started Seed Legals, I thought actually the problem was all about building legals. And it turns out that, of course, people need legals for a funding round, but what they're really looking for is something that shows them what to do. And the showing what to do is to just show the process. You do this, then you do this, then you do that. Don't do one of those. And this is market standard. And here's data to show this. So, as a founder, you know your domain, you know, you're a doctor doing dialysis, or you're making a GPS bicycle lock or something, but then there's all this legal funding stuff you have no idea. And I think in the past, when I've, you know, gone to law firms, I felt like a bit of a sausage in the machine. You know, you call somebody and they give you all these deal docs and you're going, what am I signing up for? Someone's trying to trick me. So to turn that around and to hop in and go, here's what I would like. Oh, no, don't do that. Oh, one of these. I didn't know I could do one of those. Oh, here's all the docs. Great. Push this button to sign it. I mean, after you've reviewed it, I think that transforms things.
And Alex, from your perspective, especially thinking about fintech, what are some of the opportunities that will come about in the fintech ecosystem if we do make this process easier and if we offer support to startups?
I guess the opportunities are endless. I mean, we've obviously heard about seed legals and how easy it can be. I think putting investor term sheets on a platform like that is interesting, because obviously a lot of investors have their own term sheets. They have it in their own structure, how they like it. So it'll be interesting to see how it all becomes digitized and they sort of align, because I mean, I've seen some startups make their own term sheets, which are quite a long way off what some investors expect. So yeah, I think, I guess going towards that overall goal that we have, optimizing the fundraising process, make it more efficient, because tons of time's wasted. And yeah, I mean, there's plenty of opportunities to make it quicker.
Sure.
Can I grab quickly the question on the B Corp, which is interesting? Okay, so there's a question about, you know, how easy or difficult it is for a B Corp to raise. So for those who don't know it, and I'm not an expert on that, but there's something called a B Corporation, which is about, you know, not just being for profit, but being for good as well. And B Corporation has become, started to gain popularity. So one of the things, of course, as a founder, is sometimes you want to have a mandate to do good. And so should you just aspire to do good, or should you build that into your deal docs? Should you put it into the company's articles so you have now bound yourself to certain provisions? And the challenge is that, you know, personally, you might want to have something to say the company will give N% of its profits to charity, or will plow all profits back into the business, or, you know, whatever it might be. And these might be noble, but at some point they cross over to reduce your investability, because investors, some of them are totally into it and some of them are not. Some of them are going, I'm doing this to help you run your SaaS business and make a return on my investment. Anything that's not aligned with that is taking your eye off the ball. So as soon as you go down the route of any of the B Corp, or there's a community interest company, they're not-for-profit provisions, I think you increase your investability in some areas and perhaps decrease it in others. But when it comes to the B Corp, I think B Corp, in terms of the language, is a small amount, an extra article, clause that gets added at the end of your company's articles. And actually, we've made this a one-click provision on seed legals. You still need to go to the B Corp people to get B Corp certified. But if you're doing a funding round, actually one of the things we've added in the build your term sheet is social impact provisions. So we've built in one click, the founders can give some percent of their proceeds on an exit to one of a few charities, which is an interesting model. Instead of giving money, you pledge money when you have it by sale of your shares. Or you can say, I would incorporate community interest company or B Corp provisions. So the answer is it's now fairly easy to build into your deal documents, but before doing so, have a think about, apart from your own mission statement, how does this affect your investability with different classes of investors? And you may find that it's a great win in the early stage, but when you come to VCs later, you know, it's seen as a negative. So that's something to consider.
Sure, and that's kind of almost all we've got time for now. I wanted to ask you both a final question on negotiating. If you could choose one top tip to give the audience around being a good negotiator, what would you advise people to do? Alex, we'll start with you maybe.
Sure. I would say work with someone who's credible and done it before, who knows what market is, because that'll put you in the best position to close a deal that's right for you and your business?
Sure. Anthony?
I think it all comes down to desire. And so, investors look at many, many slide decks, and it's all about pulling out the signal from the noise. In early stage rounds, nobody's got any idea whether it's going to work or not, or be popular or take off. In later stage rounds, you can look at the growth numbers, but in early stage, how's an investor going to know whether they want in or not? And for that, they want, when looking at your deck, there's some of the numbers there, the things for the head, but there's also for the heart. And so you want to create that desire. It's all about creating the desire that wants the investor to be in. And the creating the desire, some of it is in the pitch deck, but some of it is when they do a Google search, or as they're browsing their LinkedIn or Facebook groups or whatever it is. If they keep seeing your company everywhere, then that says you guys are everywhere. So, as I understand it, back in the days of Napoleon, when he has a small army, he would send some of his soldiers out onto surrounding hills and light fires in the evening on the top of the hills, and the enemy would go, we're completely surrounded. It was like a few dozen people, making a lot of noise. And that's what I like to do, which is try to have as many articles as you can out there, be ubiquitous, so that investors see you everywhere and you look larger than you are. And when that happens, then as they, see a pitch deck coming their way and going, dude, I have no idea, they go, wait, I've heard this 3 times already. 2 people have told me, and I've seen some tweets about it, and you guys are in Business Insider. This must be good. So it's all about making noise.
Definitely. We have a lot of people come to FinTech Alliance who are maybe a startup, and often help them through that process of being seen as a thought leader and being respected in the space as well. So that's all we have time for this morning, or this afternoon now. But thanks everyone so much for joining the Raise Your Game series over the last few days. Big thank you especially to John, Jonathan and Alex from Mountside, of course Anthony from Seed Legals, and everyone else who's joined us to impart their wisdom this week around investing. Thanks also to London Fintech Week and DIT for the support as well. I know there's a lot of questions that we kind of haven't got through because everyone's asked quite a lot of stuff, so we'll try to get those kind of written up and answered as well. We'll be posting plenty of resources online, as well as any video clips. So if you did miss anything or you want to go over something again, that will be available to you. In the meantime, just thanks again, everyone, and I hope you all enjoy the rest of the day.
Thank you very much.
Thanks. Cheers.